speaker, Sri T.G. Suresh, Direct Tax Committee Chairman, Sri C.A.P. Anand, Co-Chairman, Mr. T.R. Acha, Coordinator, Mr. Vijay Chodia, President-elect, Mr. Nawapan, and other colleagues in the council and members of Hindustan Chamber of Commerce and public who are joined today for this webinar. I extend my warm welcome to every one of you. All of you know that Hindustan Chamber of Commerce is regularly organizing very useful webinars for the benefit of members as well as others, so that there will be a need for joining such webinars. In this series today, we have slotted tax benefits on account of recent amendments in the Income Tax Act. I think normally whenever we talk about Hindustan Chamber of Commerce, it is very essential and my duty also to spell out few things about Hindustan Chamber of Commerce. It is one of the oldest Chamber of Commerce in India. Recently, we celebrated our Platinum Jubilee under the, chief guest being the Honorable Vice President of India, Mr. Sri Venkaiah Naidu. Also, we had guests of honor, Manipur Governor Ila Ganesan, as well as then Governor of Tamil Nadu, as our guests of honor for that particular program. I think this chamber is having a very long, good history of having many valuable presidents as well as office bearers for carrying forward the objectives of this particular chamber. In this series today, we are going to have these tax benefits. Normally, income tax is a wide subject. For a layman, sometimes it's most confusing. Particularly what I heard recently is that after introduction of a lot of things, modified version of tax uploading websites portal, I heard that it's very simple and good, and many people are able to easily file their returns. Of course, the bottlenecks were removed. But as far as the abstract of the act is concerned, it is not easy for a layman to understand. There's a lot of ifs, buts, and some comma even will change the what's called the meaning of the particular or intention of the particular section or amendment. That's why it is our duty to call experts like C.A.T.G. Suresh to to give you a full picture about the Income Tax Act. Here, the most important thing is that today it's a very positive approach. We are going to talk about, rather he's going to talk about tax benefits under the recent amendments. For all of us being tax, many of us will be taxpayers. Naturally, it's necessary to know what are the sections available to avail what kind of benefits. Because income tax is being amended every time whenever the budget is presented or in due course also. So we cannot keep track of all those amendments. That's why it is necessary to share from an experienced person like C.A.T.G. Suresh some of the aspects which are most beneficial to the taxpayers. So with this introduction, I am leaving the floor to the Direct Tax Committee Chairman, Mr. C.A.P. Anand, to introduce the subject as well as the speaker.
Thank you, President. Members assembled here, and the President gave a directive that at least minimum 2 meetings should be conducted by each of the committees, and one of them should be a grand meeting. We thought we had a lot of things to do in the Direct Taxes Committee. So hence when we met, we decided that we'll have a meetings to start with in November, and maybe the next meeting to follow in January, then a budget meeting in February. Like that we have planned for. So with this, when we talked about the subject, Secretary Chitra suggested why not we discuss the latest tax benefits under the Income Tax Act. And we could not think of any other speaker other than T. Suresh who can definitely bring about the best. Because normally, whenever income tax is introduced, it is not giving you much of a benefit, it is more a taxing statute. And whenever even courts come in favor of the assessee, the department has changed the law to say that this is what our intention and not the intention has to be court direction. This is how the law has been framed, as the President mentioned. There is more complications and all that. And now, because of the ease of doing business becoming a norm, which the government wants to implement, there are a lot of things to be done on the tax front. We had, for example, now the retrospective amendment was withdrawn, and because of that, the tax demand in the International Court of Law, Kane Energy, and somebody went to the International Court of Law to demand compensation from the government. So the government had to now press down on that and then say, yes, we will give you the refund. And so that this is the kind of thinking that's now going on, saying that we should make it easy for people to understand, people to come to the net, tax net, and then go on further. In this connection, we also now have the faceless scheme that has been introduced. So it has a lot of hitches and a lot of things that controversy that is going around. But still, it is more easier to do a digital thinking as far as a normal tax is concerned. Maybe a complicated provision to improve, interpret and all that could be a difficult one, but that is a normal one. The persons are happy that they file the return and within 1 month they are able to get the refund and whatnot. So this is how the tax law has been changed beneficial. We have also had amendments like where you had the option either to claim certain of these deductions like life insurance premium, etc., or without claiming at a lower rate of tax. You can yourself check for the which is beneficial to you and accordingly take a choice. So these are all the things that has been introduced. Same way, when the companies taxation was there, they try to reduce it from the present 30% for the domestic companies to the 25% and even up to 22% based on certain conditions. I think Suresh will take up all these benefits that have been coming in. Same way, there are other benefits that are given by the income tax under Chapter 60, where to promote certain areas, they have given some deductions. But generally, the law is getting complicated. But now, even the global thinking is changing. They does not want the capital to flow out of the country. They want the tax revenue. So they decided that a minimum rate of tax or the maximum rate of tax should be fixed, and accordingly the thinking should go on. So India is also part of that agreement, G20 agreement. So they would like to now introduce a flat rate of 15 or 20% for the companies all over the globe, so that the capital doesn't flow from one country to another, and the tax revenue stays in that country. We are having accepted, we are trying to implement that by assessment year 23-24 or so. So we can see the effect of this in the coming budget. So these are all the things that happen in the direct tax. So hence we have an eminent speaker to talk to us on some of these benefits, and where there could be some complication or confusion in that section, we'll try to clear that out and make a presentation. I'll give a brief of T.G. Suresh for people who have not heard him earlier. People who have heard him earlier will definitely know, because he's a renowned teacher for more than 3 decades in the city of Chennai. There are many students who have come out of his classes and passed out the CA examination without with more distinction, especially in the subject of taxation, costing, etc. He has been a faculty in the domestic taxation, financial management. He is a visiting faculty to the regional councils of the Institute of Chartered Accountants of India, and has been addressing many of the members all around the 4 southern districts. He is also a regular faculty with the Regional Training Institute of the Income Tax and takes classes for the income tax officers and inspectors. He has won the National Award from Capital Foundation Society in New Delhi from the Law Minister. He has also authored many books. Some of them are Simplified Approach to Direct Tax Laws, Simplified Approach to Taxation, Capital Gains Tax Law and Practice. Maybe with this or his coaching, he is known as a capital gains Suresh, because he is very, very thorough in the capital gains subject and makes it more complicated even for the lawmaker to think twice whether he has made the correct law. To that extent, he has been a thorough knowledge on the capital gains. He has presented papers on various seminars, including that of the Hindustan Chamber of Commerce, to name a few, and all other chambers and other professional institutions. He is a member of the Direct Tax Committee of the professional bodies. He is a co-opted member of the International Taxation Committee of ICA and Direct Tax Committee of Southern India Regional Council of ICA. He is presently the chairman of the International Fiscal Association, which deals in international tax exclusively. With this, I have great pleasure in welcoming our speaker of the day, T.G. Suresh, and request him to take over.
Thank you, sir. Thank you, President, and thank you, Chairman of Direct Tax Committee. It's always great pleasure in speaking before the Hindustan Chamber of Commerce. In fact, I think most of the budgets, so always we find it difficult to finish off the session in 1 or 2 hours. In fact, we always try to plan something post-budget also. So always have a fond memories. Only thing is that instead of physical interaction, we have having virtual. So we'll still try to make it as interesting in the virtual form also. I once again thank the chamber for giving me an opportunity to share my thoughts. But so the topic given is the benefits and the Income Tax Act. So tax benefits and the Income Tax Act. So therefore, when I was speaking to the chairman also, when talk about tax benefits is something which you have in your mind. So he said that you can take up the new benefits given to the manufacturing companies and sections like 115 BAA, BAB, BAC, which will be of lot of importance and relevance to the people attending today's program. So these are the 3 sections which I'll be taking up. So the benefits, you can keep on talking about it, but I'll stick on for today's discussion to these 3 sections. They're all recently introduced and some good opportunities are available to reduce the tax. As the president was saying, the topic today is an interesting topic because of the fact that it's going to give us a measure to, like save tax. That's absolutely within the legal framework. Definitely, if you're able to save the tax, there's nothing like that. So it's a great opportunity. And as the chairman was pointing out, this government has been trying to do a lot of things proactively also, so that litigations are reduced. Attempt is made. At the end of the day, it's like including faceless, everything is new. So what we need to do is every new things we start, we might have some kind of a bottlenecks, including the challenges which we had initially when this new portal was launched. I always tell my fellow chartered accountants also, we need to have a little bit of a patience in everything, because you can't expect when such a huge data is migrated, expecting that to be a smooth affair from day one is whoever does it, even if TCS, Wipro, joined Infosys also. I don't think it is possible because the data is so huge. When you shift your office and migrate your data from one computer to another computer, we face challenges. When we move to a new house, we face a lot of challenges. It's not that right from day one, our new house is absolutely smooth. Even after 2 years of moving to a new house, in this rains, there are some places some water comes. I think these are some things which all of us know. When it happens to us, we want us to be understood by others. But when it happens to the Infosys or income tax department, we somehow seem to be losing the patience. And it's also with Facebook, LinkedIn, and other social networks available, will always think that they can make any observations. But I'm sure that chamber has been always been proactive and makes a very, very constructive observations, and also has given some good suggestions. I think that's what it's a partnership between we and I think that's what we should all try to do. Some of the sections are great initiatives. I think definitely a lot of scope is available for us to reduce the tax. I think we must first compliment the government for introducing really bold measures. I think definitely these are some very, very bold tax rates. And of course, all because of the Prime Minister's invasion of Atmanirbhar, as we all talk about China plus one. So I think these are the sections which definitely will help us to really achieve that targets. And I think we should make use of the wonderful opportunity provided by the government. Now let's look at why this 115 BAB, which is basically a tax on new manufacturing, was introduced. Obviously, this is there in the memorandum. It's not my version of it. So in order to attract the fresh investment in manufacturing and thereby provide boost to Make in India initiative, the government, a new provision has been inserted from financial 1920, which allows any new domestic company incorporated on or after 1st October 2019. So that means first thing, this benefit will be available when you incorporate a new company from 1st October 2019. We will go into the nuances of section as we get along. Making fresh investment in manufacturing and they've been given an option to pay income tax at the rate of 15%. Just imagine, just 15% tax. And this benefit is available for any companies which start manufacturing from up to 31st March 2023 from 1st October 2019. Now, there are certain exemptions, incentives are not available. I think most of them in any case from the last year itself has gone to virtually. There is no benefit is available in those sections. So, but however, irrespective of the taxable income, since there is going to be a 10% surcharge and 4% cess, effectively the tax rate goes to 17.01%, just a 17% tax, including the taxes. And of course, there is no MAT at all. There is no MAT, only 17% tax. That is another couple of years is still available. So we still have, we are in only November 2021 now. So we have another 4 months plus we have another 2 years to take advantage of another 16 months or so to still plan on this particular section. In my gut feeling, the 31st March 2023 could be also pushed another 2-3 years, given the fact that definitely the world is looking for an alternative to China. For that scale, I don't think there is any other country can come closer to them. If at all some country can come closer to them, I think that will be India, because of the sheer size of it. There are other countries that are Vietnam and all, but I don't think they can match the size that what we have. So if at all somebody can come closer, what they built, I think that is one step that the government has taken apart from the other incentives and the other laws. From the taxation point of view, a 17% tax, I think is a very, very, very attractive tax. Very, very attractive tax. I think something which all of us should try to explore. But so what should I do to get this benefit of 17% tax? So you have to set up and register the company on or after 1st October 2019. That means it must be a new company set up and registered on or after 1st day of 2019. That means an existing incorporated company cannot avail this benefit. If you have incorporated on or after 1st October 2019, so you can go for this particular section. The company should commence manufacturing or production of an article or thing on or before 31st day of March 2023. So as I mentioned earlier, this definitely they might extend this by another couple of years also. There's always been the practice. Initially they try to give for some years and then they try to extend the benefit. But right now, as on this particular day, you have to commence the manufacturing or production before 31st of March 2023. Definitely, there is a good reason for extending the time because of the last 2 years has been virtually been a washout most of the days because of the COVID threats. The business should not be formed by splitting up or reconstruction of a business already in existence. So that means you cannot immediately, when you say that you should start a new company, a new production, people might simply try to shut down the existing one and then try to take that to the new company take the benefit. So that is why they're trying to put a condition. The business is not formed by splitting up or reconstruction of a business already in existence. It does not use any machinery or plant which are previously used for any purpose. It does not use any machinery or plant previously used for any purpose. So the idea should be you cannot stop the existing production, do the machinery here and take the benefit of this particular section. Does not use any building previously used as a hotel or a convention center, which you already claimed some tax holiday benefit and the 80/80. So 80/80 has been discontinued long back. I don't think this condition is a very serious condition to look into. The company is not engaged in any business other than the business of manufacture or production of any articles or thing and research in relation to or distribution of such articles or thing manufactured or produced by it. So therefore, basically, you are not supposed to engage in any other business other than manufacture production of articles. At best, what you can do is you can do a research in relation to or distribution of such articles or to manufacture produce. So you can set up a research and development activity for further enhancement. So therefore, you must be engaged in the manufacture or production. So when they talk about the manufacturing, that they just come out with the businesses which are not eligible. So these are the businesses which are specifically been provided as not eligible for the new provisions. The concession rate of 17% is not available if you are going to be in the business of development of computer software in any form or in any medium. So these, if you are going to develop computer software, this section may not help you. So mining business, not eligible for this concession rate of tax. Conversion of marble blocks or similar items into slab.
Suresh, you are muted.
No, I muted everybody. Okay, now go ahead, sir.
Okay.
You can go ahead, sir.
So printing of books or production of cinematograph film is also not going to be eligible. And the government is always tries to keep one thing in its sleeves. Any other business as may be notified by the central government and this speak up. So therefore, they just want to take, so in future also, they can also come out with some ineligible businesses. I feel this clause should not be there at all, because they should decide once for all what are the businesses which are ineligible, because there cannot be a situation where because it is not there in the list, I start that business and suddenly you come back and say that is not eligible. And I think that is something which always, given the fact this government is always trying to ease the ease of doing business, and these are the clauses which has to be obviously removed, because you just bring it at the first stroke. Otherwise, don't try to reserve anything and try to look into any retrospective change. At the end of the day, if I get benefit for 2 years and suddenly say I'm ineligible, that may not be fair. So in order to get this benefit of 17%, you're not going to get some provisions of Income Tax Act. That's what's already mentioned in the memorandum also, that certain benefits are not going to be available. 10AA, I don't think we need to seriously worry about 10AA, because already you are not going to get this benefit anymore, because already the tax holiday for setting up in ACZ has already been discontinued. So therefore, I don't think that is a very serious issue. Additional depreciation for the new manufacturer, which is currently available at the rate of 20% of actual cost. So that is not going to be available. And all these things, 35(2), 35(2)A, 35 III, 35 2AA, 2AB. Earlier, these sections were providing for a weighted deduction already for research and research related activities. All these sections have already now become 100%. I think, in fact, the best thing they can do is they could have easily discontinued these sections itself. There's no necessity to keep this section. They can merge all these points along with section 37(1). These are some things which Central Board of Direct Taxes should come out. See, they have to think in line with the government's thinking. You cannot have a situation where saying that these sections are not going to be available, because these sections, when if you go and recall in the first budget itself, Arun Jaitley started saying, I want to reduce the tax rate, but progressively I want to really reduce the weight deductions, and progressively I will just keep on reducing the tax. This was his idea in 2015 itself. The only thing is that we will find out some ways to identify the sections. He has already set the roadmap. So what they could have ideally done is they can remove this section. The having where is 100%. I don't think they should have excluded these sections, but for some very strange reasons, this section is no longer eligible for a weight deduction. That extra percentage was there earlier. The government felt that I can't give two benefits at the same time. The weight deduction already gone. All the sections are available only with the 100%. I think Chamber should recommend that in these calculations, the 35(2), 2A, 3, 2A, 2AB point has to be removed in these sections. I think that is my suggestion to the Chamber. 3580, which is basically for certain businesses, we give an investment-based linked incentive. So investment-based investing. All the sections were earlier there.
Sir.
On the basis of profit-based under 80IA series. So now the government felt that profit-based incentives are being.
Sir.
Yes. Hello.
Please go ahead, sir. Somebody's in. Please go ahead. No problem.
Hello?
Mr. Suresh, you can go ahead, sir. Somebody
was-
yeah,
yeah.
you can go ahead, sir. No problem. Others, please mute, sir. Please.
Yeah.
Yeah.
So basically, the profit-based incentives, the government through its committee has found that profit-based incentives are generally being misused, and therefore they moved from the profit-based incentives to investment-based incentives. Because the idea began the profit-based incentives, because all the sections of profit-based incentives, if you can recall, like 80HH or 80HH or 80I or 80IB, etc. So all of them want certain number of workers to be employed. So basically, those sections are intended for generating employment, generating a lot of employment and other benefits. But sometimes it didn't actually accrue. So therefore, what the government over a period of time decided to move from a profit-based incentive to investment-based incentive. So if you go to 3580, you will find you can claim reduction for capital expenditures except expenditures on land or goodwill or financial instruments. So only for those sections, those capital expenditures, you will not get the deduction. The rest of the capital expenditures like building or plant and machinery for 15 businesses, they will get the entire capex as a deduction. So they don't want a situation where you get 3580 also and also get a 17% tax. You cannot have the best of both. At the end of the day, I can't give you multiple incentives given the fact that government also needs a lot of revenue for the purposes of meeting its social objectives. So therefore, they thought that you cannot have multiple incentives inbuilt. So already given you 17% tax, I can't give you other benefits also. That is the intention of keeping 3580 out. 35CCC and 35CCD, which are agricultural extension project and skill development project. Again, this also I think Chamber should take up, because earlier this section provided for a 150% reduction, 150% weight reduction for any contribution we make to institutions which are engaged in agricultural extension project or skill development project. Now that 150 has been reduced to 100%. As Jacob,
So we can have question answer last, sir. We can have it. You can go ahead, please.
Jacob is raising hand and I think so.
Problem, sir. You can go ahead, sir. You can go ahead.
So even today, the skilled labor is always a challenge. So therefore, when you make a contribution, you're going to get the reduction. So though we have a huge youth manpower, but how many of them are employable is the challenge. So these sections are earlier introduced for the purpose of weight reduction, but all of them now have moved to 100% reduction, not a weight reduction of 150%. And therefore, I think we should recommend to completely exclude this, because this is no longer their incentives. These are normal benefits which are given. So therefore, except for 10AA, 3212 and 3580, all other sections I think largely should be, of course, Chapter 6A, except ATM, which is basically available for intercorp when you distribute dividends. Out of the dividends received, you're going to get a deduction in ATM to prevent multiple taxation. That section you can continue. 80JJW, which is a very, very important section. I still find a lot of people are not using this 80JJW, which is a deduction available for employing new workmen, which is provided with 30% of additional wages for a period of 3 years, which is a very important concession. That concession continues even if you're going to go for a new tax regime. So, but however, a very important point which I want to bring to your attention for those under the new tax scheme up to last year, they said that you will not get. Jacob?
Yes.
So you are frequently getting.
Sir, please, sir, mute your mic, sir. Please. Question and answer, you can have it in the end, sir. Please.
So we are up to last year, they were only saying you will not get only Part C of Chapter 60. You will not get only Part C of Chapter 60. That means you will get 80C to 80GGC. That was still available. And then especially very importantly, ATG is available because a lot of people are donating to Prime Minister's cash fund and all. So for the COVID related benefits, and those things were available up to last year, but now you will not get any chapter 6 reduction, including ADG, except for dividend, which is paid out of the dividend income, and 30% of additional wages given to the new workmen. So those are the only two sections you can claim. Rest of the chapter 6A, you have to forego if you want to take the 17% tax, which is, I think, is fair point. So the idea is to minimize litigation, minimize deductions, and therefore that's fine. But however, I say, I think we should definitely represent, except for 10AA, 35AD, 3212A in chapter 6A part of it. Rest of the sections no longer are additional benefit. They are normal expenditures which are allowed as deduction. I think we should bat for claiming those deductions, even if I go for this 17% scheme. Now, 72A is basically available for mergers and demergers. So therefore, if you form a company and merge in existing businesses, you are entitled to 72A benefit, but to the extent attributable to the above deductions. And if, because under 72A, for the benefit of those who may not be aware of 72A. So if you formed an existing company, with your company, if an existing business gets merged, in those circumstances, so you can carry forward the losses, business loss and depreciation of that company to you. But however, those depreciation loss and business loss attributable to what is mentioned in this slide, you will not be in a position to adjust. So say basically 72 is available for merger, demerger, and in the consequence of merger, demerger, the business losses and the depreciation loss which are entitled to adjust from the previous company to extent attributable to additional depreciation and to the extent attributable to 35 to 2A, 2AA, 2AB, and to the extent is attributable to the sections which are mentioned in 2, 3, 4, 5, you will not be in a position to get it. So that's about what are the deductions for why to get the 17%, what should you do? Is the question. So this is a very important point which we discussed, where you should not use machinery or plant previously used for any purpose. That is one of the conditions. Now, one important point is that, so when this condition is not applicable, that is, to put it differently, under what circumstances you can use the machinery or plant which are previously used for any purpose also. Just to make the discussion a little bit more simpler, I will try to put it as a second-hand machinery. So normally when you have a second-hand machinery or used machinery into this new business, you are not entitled to claim the 17% tax benefit. So this slide will explain you. So what circumstances you can use used machinery also. You can just read it that way. Such a machinery or plant was not at any time previous to the date of installation used in India. That means if you are using a machinery which is already imported to India, so if you import a used machinery into India, then that will not be considered as a used machinery, provided these three conditions are satisfied. So what are those three conditions? Before you bring it to India, that machine should not have been used in India. So it should not have been used at any time in India. Such machinery or plant is imported to India from any country outside India, because that I already given in the heading itself. And in respect of that machinery, no deduction should have been allowed or allowable under the provisions of this Act in computing the total income any person prior to the installation. That means the person for whom you have imported, he should not be eligible for depreciation, or he should not have been allowed the depreciation in respect to this machine. To put the point in more simple one, you can use an used machine, you can import it, and you can still consider it as not a used machine. You can take this as a new machine, provided before you bring it to India, it has never been used in India. The second point, no depreciation has been either allowed or allowable in respect of the same. So therefore, if the person to whom you are
Mr. Suresh? Hello? Mr. Suresh? Mr. Anand? Help it there.
Sir, I think they are in unmute only. Actually, they can speak.
Sir, I think,
What happened to Mr. Suresh?
yeah. Mr. Anand is trying his number, sorry,
Yeah, I saw that. Maybe
probably.
connectivity.
But there was a bandwidth issue right from the beginning at TG's office. I could see that.
Okay.
It was always showing low bandwidth.
You can go ahead, sir, Mr.
Suresh,
Suresh.
unmute. Suresh, unmute yourself.
Yeah, I'm unmuted.
Well, our TG sir.
Yes, Suresh, continue.
Sir, I think share screen should be.
Scan sheet?
Share screen option to be in, sir. You have to make me co-host.
Okay.
Yeah, given host, sir. I given
Host given, sir. Given.
Given, sir. Yeah. Because of that network issue, it was disconnected.
Yeah. Now it is working. Yeah.
Fine, sir. Yeah.
So in respect of imported machine, these are the conditions. But if it is not an imported machine, it's going to be a lot more simpler. The used machine, the total value of machine should not exceed 20%. The total value of the machinery plant does not exceed 20% of the total value of machinery plant. That means if you're going to invest, say, 100 crores, the used machine can comprise of 20 crores. Now, there's a very interesting issue here. Similar wordings are there in a lot of sections of Income Tax Act, like ATHH, ATI. There are so many sections cover this particular point. Now, so in this particular case, the only point what we need to consider here. So for this 20% of used machine, can I buy from my holding company or something? We have already seen at the beginning, it should not be formed by splitting up of existing unit. So what if I form a subsidiary company and if I move my machine to the subsidiary company, will this be a violation? Prima facie, it looks the answer is no, because of the fact. So while interpreting this particular section, the courts have held that previously used for any purpose means it is to be previously used for any purpose by the assessee. So therefore, if I'm going to buy a second-hand machine from somebody, including my holding company, whether that will be considered as a second-hand machinery or used machinery, it looks on a prima facie reading of the section and the interpretation by the courts that can still be considered as a new machine. Just to give you a small example for this particular point, I have 100 lakhs, maybe take it as 100 crores also to make it a little bit more bigger. And I have machinery used by the holding company transferred to this company, 30 lakhs. Now, total of my machinery, 100 plus 30, 130. 20% of that comes to 26 lakhs. Whereas the used machinery, which is transferred to me, comes to 30 lakhs. Does it mean I'm violating this section? The answer, in my view, is no, because of the interpretation for the similar wordings in some other section by the courts. So unless the machinery used by the assessee himself is
shut up.
So the question of that being considered as a used machinery does not arise. So that was the position taken. The wordings in this section also
Shut up.
came like the other sections. So therefore, it is possible to take a stand unless I transfer my own. The question of using supervision does not arise. So in the context of this section, given the fact that I should incorporate October 19. So,
Shut up.
Jacob, I think so. We are frequently getting disturbance from you. So
I think he's doing it intentionally, sir. Someone please kick him out.
Bitch, you shut up. You fucking Indians.
Hello, Mr. Jacob, please mute, sir.
Sir, don't talk to him. Just send him out.
Huh?
Send him out, sir. Send him
I
out.
think
Who is
that's
the
what I'm
admin?
saying. I don't know.
Sir, who is the admin? Admin has to do this.
Sir, he's not even Indian, sir. He's some other country who's actually randomly joining this
Yeah.
webinar and then speaking some news.
Indians are so.
Hey,
You remove him. You remove him, please.
just kick this guy.
You
He's
remove
some-
him.
You guys
Sir,
Indians
admin, any
are so
admin can
fuck.
remove.
Sir, I actually he's again he's joining in between. If
No,
you
I'm
remove-
removing. I'm removing.
Kindly remove him, sir. Yeah, thank you.
So, so here the 100 lakhs, 30 lakhs. Now, whether this total comes to 130, 20% of 130 is 26. Does it mean that I have not complied with the section? The answer is no. I'm complied with the section alone because of the fact that 20% or wordings of the similar section so the courts have held that it must be my own machinery, which I should bring it here. Then only be considered as a used machine. So only in the case of imported machine, it can be from any person. That's what the courts are trying to interpret. That's why I taken another example, which is a lot more easier. New machinery 100 lakhs, machine used by the holding company, transferred to the company 30 lakhs. Assume the holding company is a foreign company. The machine is not previously used in India, and no depreciation has been claimed by the holding company. This is absolutely got no problem because section is very.
Oh, really?
Jacob, who are you at? Why you are disturbing the session?
I don't care.
No, but why don't we have a waiting room?
give
Suresh,
a
the
fuck.
president, I think ask the admin to have a waiting room so that you can admit only those.
I will kill y'all.
Putting in waiting room now. I put him in waiting room now. Okay.
No, sir, remove him and then enable waiting room so that he cannot join.
Okay.
You guys Indian are so dumb. Fuck you all.
Not able to do anything now. You go ahead, sir. Speaker, please go ahead.
Sir, enable waiting room before he joins again.
No, I put him. Let us see. You please start, sir.
Okay.
So here, when the holding company becomes a foreign company, there is no issue at all because the conditions for imported machine is very simple. It should not be used in India before, and no depreciation have been claimed. Then it becomes as good as a new machine. But if it is going to be in India, the one equation which arises now: will I lose the benefit? As a question. Based on the identical wordings in other sections, the courts have held it must be previously used by the assessee. If I'm going to buy from somebody, including my holding company or subsidiary company, then even though it's a used machine, it will be still viewed only as a new machine. That means in my both examples, the answer is not going to really change. So therefore, that is something which you need to consider how to take the 17% advantage without violating the conditions of splitting up, etc. So apart from it, given the 17% tax, there is always a possibility that the intergroup companies transaction could happen in such a manner where the profits are going to be skewed in favor of this particular company. So whereby you shift the profits to this division or this company and take the 17% advantage. So therefore, to prevent this misuse, you also have subsection 6 of this section specifically providing, that is 115 BAB, specifically providing. So while it appears to the assessing officer that owing to the connection between the two parties, if the profits produced are more than the ordinary profits which are expected to arise in the business, so what they can do is they can arrive at the reasonable profits, and that excess profits is not going to be taxed at this 17% tax rate. For their purpose, they can also invoke transfer pricing regulations, so that you can bring in the arm's length concept to this. They also call it a specific domestic transaction. So, and that excess profit, instead of being taxed at the rate of 17%, so will become taxable at the rate of 30%. So you will not get any concession here. Even you will not get the even if your turnover matches the tax rate of 20%, still this will be subject tax at the 30% tax bracket. That means it's the highest tax rate applicable to the company is what you have to pay as a tax. So what are the other points which are worthwhile to be considered here? You should exercise the option in the first year. So in the first year itself, you have to exercise in the year in which you started your business. In that year, you have to choose the option. The option should be exercised on or before the due date for furnishing the return of income under section 139(1). The option should be exercised on or before the due date for furnishing the return of income under section 139(1). So one logical question arises. Suppose I could not file the tax returns in time and I file a belated return. So will I be in a position to get the benefit of this particular section? That is one very important logical question which will arise. So for this purpose, we have to consider, is 139(4) a belated return section? Is that section capable of being there as an independent section? That is the most important part. So let's just do, for the benefit of all of you, just like at the scheme of the section. So 139(1) provides for voluntary filing of income tax return within certain due dates, ignoring the extended due dates in the last 2 years due to the COVID-related issues. 31st July is for individuals primarily. And then you have 31st October for companies and tax audit cases. And for persons who are having international transaction, the due date will be 30th of November. So you can file the return after the due date also. Though of course they reduced from the end of the assessment day, they further reduced by 3 months. So that means you can go up to 31st of December to file a belated return or a revised return. I just leave this year has been extended on account of the COVID related issues. The normal due date is 31st July, 31st October, 30th November. Belated and revised return now has been further shrink. It has come to 31st of December. Without considering the extensions which got for this year. Just leave it for a moment. I could not file my tax returns by 31st of October. So I'm allowed to file the return till 31st of December. So when I file the tax returns, can I offer the 17% tax? Is the question. So on the plain reading of the section, it appears the option should be exercised on or before the due date for furnishing return of income under 139(1). The option should be exercised on or before the due date for furnishing the return of income under 139(1). So the plain vanilla answer for this question, if you file a belated return, you will not get the benefit because the section only talks about 139(1). But however, this being an incentive section, I think there is a good case for us to make an argument. So a mere non-exercise at the time of 139(1), because I'm not filed the return of income to 139(1). So 139(4) is not an independent section. See, just look for a moment. Tomorrow the government comes out with a very interesting proposal that no one in India should file your tax returns. There's no requirement for you to file the tax returns. So that means 139(1) is gone. Assuming the section 139(1) has been omitted, without omitting 139(4), can 139(4) stand? I removed 139(1). Finance Minister gives you a wonderful announcement. So in this budget, she comes out with a novel proposal. No requirement to file the tax returns. No person should file the tax returns. Whoever want to file, we will send them notice, you file. You don't have to file. The moment I'm not required to file the return of income, can 139(4) exist? Obviously, the answer is no. The existence of 139(4) depends upon the existence of section 139(1). So therefore, there is nothing called 113(4). 113(4) is nothing but a return which is required to be furnished in the 113(1) is what is extended to 113(4). And this being an incentive section, for those who still can make an aggressive stand, that still I can continue to get the benefit even if I file a belated return. A lot of cases even has come in section 54 and 54 in the deposit scheme. Even in those circumstances, when the section used the word 113(1), the courts have tried to extend it to 113(4) also. But however, assuming you file the tax return in the 113(1), and at the time of filing of tax returns, either because of ignorance or for some reason, you failed to go for the option of 17% tax. But subsequently, you realize that you have not chosen this concession rate of tax. Can you file a revised return of income and then claim 17% tax? I don't think this is going to be a challenge for two reasons. A revised return replaces the original return, and the revised return will be deemed to have been filed on the date of original return. Therefore, I don't find any challenges if somebody fails to claim in 113(1) return, but subsequently revise the return within the time allowed. And he should be in a position to get the benefit of the 17% tax merely because he has not exercised at the time of filing of tax return. He can still do it if he is able to revise the return within the time allowed. But however, 113(4) is going to be very debatable, but based on the wordings in some other section, the courts have taken liberally a few points. A lot of cases we can always find where the section said 113(1) also. In a lot of places where when an incentive section is given, the courts have been generally considerate, and the reason for that considerate upon among all the reasons, 113(4) is not an independent section on its own. So it's a section which is dependent on 113. If there is no 113, there is no 113(4). It cannot exist independently. So therefore, for all practical purposes, we can try to take a stand written under 113(4). It's also written under 113(1), but that is going to be a riskier option. It's always better you file the return on time and take the benefit rather than go into the litigation and try to take the stand. So option once exercised, that's a problem here. Once you exercise the option, then it's going to be applicable to the subsequent assessment years also. But I don't find any big challenge in now because of the fact that under this section, this is not going to be a serious point because unless the normal tax rates are reduced dramatically, this is not going to challenge. At best, what is the reduction you're going to get here? The benefit you get. The 10AA is no longer there. Most of the weighted sections are not there. So therefore, I don't think there could be any chances where you may not have to exercise this option. In the sense, like obviously this is something where there is nothing to choose for you here because of that this section is always likely to be of a lesser taxability for you than the other provisions unless the government decides to reduce the tax rates further in respect of those sections. I mean, the normal tax rate is 24% if you satisfy some turnover criteria. I doubt whether you're going to have such a kind of situation. So most of the cases, I think I can continue to choose this section. I don't find going to be a big challenge here. So where the person fails to satisfy the conditions mentioned in subsection 2 in any previous year, the option shall become invalid in respect to the assessment year relevant to that previous year in subsequent assessment years. Very important point. Let's assume first 2 years I've satisfied the condition and I've chosen the 17% tax. A third year, for example, I might use to machinery condition process at 20%. That's the easy one. So now will I lose the benefit of the 17% tax right from year 1 or only from that year in which I violate? I think to that extent section seems to be making it very clear. So you will lose the benefit only from the year in which you violate. It is not going to take retrospective, not from the first year in which you started claiming the 17% tax. But only thing is that from the year in which you violate, you lose the benefit and you can also cannot claim the benefit in the subsequent assessment years also. So therefore, that is one very interesting point. But having said this, the section gives you a very interesting twist here that if you violate this section, and you cannot go for 17% tax, then you can still go for the 22% tax provided you are able to satisfy that condition. That means 115 BAB if it is violated, you can still choose 115 BAA. That is something which is an available option. So that's a very interesting point. So surcharge at the rate of 10% will apply irrespective of the total income. You need not have to see normally, you know, at up to 1 crore, there's no surcharge. Then you have 2 surcharges between 1 to 10 crores and 10 crores and above for a companies. As far as this section is concerned, surcharge will start right from the first rupee of income. Just of course, in any case, for everybody is 4% right from the first rupee of income. So therefore, effectively in this particular case, that's why in the first slide itself I put it's going to be 15% plus 10% 16.5 plus 4% of 16.5. That's going to be taken to 17, close to 17%. So maybe taken to 17.01, but we can take it to 17%. So the 115 JB makes it very clear that if you're going to choose either 115 BAA or BAB, the provisions of minimum alternate tax will not apply. So that is something which is very important. So you are not subject to MAT tax at all. It's always going to be state only tax under this provisions alone. So apart from this, the tax rate for other income, which are specifically given in the section, as already mentioned, the excess profit generated as per subsection 6, that is due to the close proximity or relationship with your other person, you are generating more profit than what normally anybody else could generate. For that excess profit, instead of 17% tax, you have to pay 30% tax plus, of course, applicable surcharge and cess. So any income other than derived from manufacturing activity, so will suffer 22% tax. So income derived from other than derived from manufacturing or production activity. Short-term capital gains other than depreciable assets will also attract 22% tax. So short-term capital gains other than depreciable, like your short-term capital gains on sale of shares other than 111A will attract a 22% tax. So the one question which arises, the section says short-term capital gains other than depreciable assets, 22% tax. A short-term capital gains on listed shares on which STT is paid normally attracts only 15% tax. So whether in such circumstances should 22% tax will apply or should they have to apply the provisions of 111A? Because of the opening wording of the section, notwithstanding anything contained other than in the two sections, possibly the department could take a stand that 111A will not prevail over this section, and they may say that you may still have to pay 22% tax, which again we need to really represent and get clarity. I feel that 111A, 112, 112B are more specific sections, and those sections should always prevail over these sections, and therefore the rate of tax applied should be only that. But however, on the basis of the opening wordings of the section, it looks like I might come back and say that you ought to pay tax at the rate of 22%, even though it's otherwise taxable at the 15% alone. So what will happen in the case of short-term capital gains from depreciable assets? I think it looks prima facie, since the depreciable assets are already used in the business, and any capital gains you get out of the same, on the basis of this clarity appears that might also get the advantage of 17% tax. So that seems to be the intention of the legislation here, because when they try to come back and say short-term capital gains other than depreciable is 22%. So short-term capital gains on account of depreciable assets should attract only 15% tax, because those assets you already use it in your business. Possibly they're just trying to give the same concession rate of tax for that also. But however, it is possible for the department, as always, might take a stand that it is not derived from manufacture, because when you are selling a depreciable asset, we can't say that income is attributable to the manufacturer. So therefore, if it is not going to fit in under the last point, short-term capital other than depreciable assets, they will still try to take a stand. It is an income derived other than from manufacture production of articles or things, and therefore the department could still take a stand. You cannot get that 17% tax for this. You will only get 22% tax. So in that particular case, obviously they can simply say short-term capital gains, right? So all short-term capital gains they can say 22%. So therefore that may not be the appropriate stand. But however, again, of course, all of us know litigation is part and parcel of it. These are some things which the chamber should recommend given this, but the government should also clarify. I think in our pre-budget memorandum, I think these are the areas so we can take up specifically. In fact, there are one interesting point in the section I don't think I've not seen in my close to 40 years of experience. This one section says if there are some practical problems, challenges in implementing this section, so the government's has said, or the section says, please bring it to the notice for us to do whatever it takes to implement the section. I don't think any section of Income Tax Act does say that. So therefore, definitely the Atmanirbhar and the India manufacturing theme seems to be the one core reason for the same. I think we should also, as a chamber, we should all represent to bring few clarities which are still there. Otherwise, it's an important section, and we can definitely make it work even better. So I don't want to get too much into this particular part. I just want to really bring it to your attention because the benefit is available when you're going to manufacture or produce any article. So the word manufacture is not a problem because it has been specifically defined. It's been defined by section 229BA. The manufacture with its grammatical variations means a change in a non-living physical object or article resulting in transformation of the object or articles or thing into a new and distinct object or article thing having a different name. So it must result in transformation of the object or article into a new and distinct object or thing having a different name or character use. For example, I bought a computer with an 8 GB RAM. I find under the new portal, using even an 8 GB RAM, uploading becomes a challenge. So therefore, I go to my computer seller, ask them, can you make that 8 GB into a 16 GB? So he removes that 8 GB memory and puts 16 GB. Can I say it's a manufacturer? So now I don't think making it 8 GB into a 16 GB is not going to result in a new and distinct object article having a different name. It's going to be the same. Only thing is that the speed is going to go. So I have a car, which is a petrol car. I just want to make it as a, it's done in gas also. I don't think that is going to transform into a completely new and distinct object as such. So that is something which always should take into account. The bringing into existence of a new and distinct object article, I think with a different chemical composition or integral structure. So I think unless I'm going to come on to the second point, it becomes a different chemical composition integral structure, which I can maybe try to make a claim in the case of a gasoline car when compared to the petrol car, I mean, say the composition has changed. So there I could make a claim, but my 8 GB RAM into 16 GB RAM is neither going to fit in my part A or in my part B. But there is a definition available for a manufacture. Production has not been defined. The word manufacture and production are not the same. It's different. And the word production has got much wider connotation when compared to the manufacture. So therefore, the Supreme Court in Hindustan petrochemical case has specifically held that any activity which brings a commercially new product into existence constitutes production. A commercial new product into existence constitutes the production. So therefore, the benefit is available whether you are manufacturing or producing. Therefore, even if you don't come under the manufacturing definition, specifically in section 2, still try to bring in the production. So you can ask the question, so how do you differentiate? How do I can know that if I don't come and manufacture, come under production? A lot of decisions are there in section 80HH, 80HH, because I don't want you to you just board on you with various instances of how the various courts have held. Because it's going to differ based on facts and circumstances of each case. To give a list of case law, I'm sure that possibly is not going to be do-all, end-all case. So therefore, just giving you from where you can search whether you're going to fit in into the production. A lot of cases.
Bro, what is that? The red thing on your forehead.
Somehow is
Suresh
able
sir,
to.
can you remove him and start this waiting so that
Sir, we removed, sir. We removed
Okay.
actually.
enabled waiting room?
Oh, yeah, I wait. I put the waiting
No,
also.
it's still there.
Yeah.
Somehow he's able to find his
He's
way.
coming and going, sir. See, that is the
Never
problem.
mind.
He is not constantly staying. He's coming and going. There is the problem. So that we can't do. Waiting room also will not help actually, because you don't know who is in the waiting room.
Sir, there is an option in actually
in
Zoom.
waiting room, yeah.
Someone can actually only if admin or host permits, then only we can actually join the call. I have seen
Sir,
it in
no, it is
invitation.
not possible, sir. How do you know who is it, in waiting room? Waiting
Then
room,
first remove him, sir.
you cannot access everybody who is, it is impossible. When you have rush of people, how can I check? Physically, I can see you, but waiting room, how can I do that?
Okay.
Somebody is hacking, actually, nothing else. I think we have to, I already complained to Zoom about this gentleman. Okay. You can carry on, sir. Finish.
Meanwhile, remove him, sir. He's there, James.
No, if he comes only, he's coming and going without, giving
Okay,
me
okay,
time
okay.
to do
Shut
it.
up, you dumbass.
See, he's coming and going. That's what I'm saying. He's just coming and
Okay.
going. Okay. Please go on, sir. You finish.
It's the first time it's happening to you, or
First time, sir. Nobody has come like this. This is the first time. Please go ahead, sir. Please go ahead.
Yeah.
You go ahead, sir.
All Indians are so dumb.
Like a parliamentary disturbance, we have to continue the amendments, everything, and pass the
I
resolution.
want to destroy India.
I put him in the waiting room, sir. Please go ahead, sir.
yeah. As I said, you can do a reliance on the stations rendered in 88H, which will give you some idea as to how you can consider self-production or manufacture. So that's about 115 BAB. Definitely a section which so you can actively consider, given the fact it's going to be only 17% tax. As against the 17% tax, section 115 BW, which is available for an existing domestic company, therefore goes certain incentives which we already discussed. So you'll be entitled to a 22% tax as against 25 or 30 as the case may be. The sections which are not available are going to be same as what we discussed at the time of 115 BAB. So therefore not much. I'm just not going to repeat this. So other points are the option should be exercised on or before the due date. Of course, this we already discussed, whether 139(4) and 5 can also have the same benefit. Option once exercised, like that section, shall apply to subsequent assessment years also. Once exercised option, you cannot withdraw the same for subsequent assessment years. I think this is something which possibly, like as a recommendation, we can just try. They can just give it as an year-on-year option. So there's no necessity that we should exercise once for all. But that is something which we can at least make a suggestion from the chamber's point of view. 10% surcharge, 4% cess, everything else runs the same. So only thing is that you forego certain benefits, you can claim the benefit. Again, one thing which I would like to bring it to your attention, for example, 35(2)AB. For assessment year 2021-22, it has moved from 150 to 100%. 35AB 2AB also requires a lot of certification to be given, forms to be submitted, DSAR should make an approval of your expenditure and all those things. So one point which can be explored here, should we have to claim 35(2)AB? Because up to last year, there is a requirement to claim deduction at a 35(2)AB, primarily because of the fact it was giving 150% of the expenditure incurred as a reduction. In basically 35(2)AB is a reduction for in-house research and development undertaken by a company engaged in certain businesses. You also get a reduction under section 35(1)(1) and under section 35(1)(4) for scientific research.
Hi guys, I just want to apologize for what I did, and I'm gonna leave. I'm gonna leave.
So 35(2)AB is subject to certain conditions, whereas 35(1)(1) and 35(1)(4), which are available for all associates and all businesses, does not have.
Psych, you can stop me, bitches.
So it is available irrespective of to satisfying certain conditions. It's more out of a self-regulation is what is really required. No forms are also required to be submitted. So always all 35 2AB automatically will qualify under 3511 or under 3514. Now, if you're going to claim 35 2AB, that deduction which you claim under 35 2AB needs to be added back if you've chosen the new tax regime. That is, you're going to choose this 22% tax. So therefore, one possibility you can explore, instead of claiming 35 2AB, can you claim this R&D expenditure as a deduction under 3511 and 3514? Because 3511 and 14 doesn't require any condition to be satisfied. So why should somebody exercise 2AB? Because if you already exercised the new tax regime, and if you're going to claim 2AB for this year, which also needs to be given in your audit report, as well as you need to file up a specific form for claiming. Now, what is the big deal in claiming 100% and disclosure all those things? Invariably, those who have claimed 35 day, every year DSIR makes some disallowance or other. So therefore, basically this all research and development qualify under 35, including in-house R&D. So therefore, instead of claiming 35 2AB, there is a possibility of claiming it under 3511 and 14 can be explored, so that you don't have to pay add back this item for the purposes of 22% tax. That is something which you can explore if you have already last year opted for this particular section, or if you're going to opt for this under this section, and if 35 2AB is acting as a kind of an hindrance for you to claim, I think that is one thing which you can explore. And as I already told you, so we can specifically recommend with all the sections, weight reduction section and 3580 or 35 triple CNC, they gone to 100%. The main purpose of this not being considered itself because they're getting a weight reduction. With weight reduction removed, I think we should actively take a representation that removing this, except 10AA, 3212A, 3580, chapter 6A. I think the rest of the sections we should say that under the new tax regime should also be excluded for the purposes of going for a new tax regime. That is something which chamber can actively consider. So this is as far as the other section for domestic companies concerned. So last but not the least, we generally never forget the individuals and HULs who. So at least companies do have some chartered accountants to pay. Normally, the individuals and HUL who have been given some new tax regime under 115 BSC from this assessment here. So we'll just also run through the revisions for them. So now, instead of trying to normally, as all of us are aware of, the tax rates are given by the Finance Act, but for a change, the Income Tax Act provides the slab rate of tax. So the slab rate of tax, if you're going to choose this section, so tax slab rate is provided by this particular section itself. So up to 2.5 lakh, there is no problem. It's going to be nil and in there also. So there is no separate tax slab rate is available for senior citizen or very senior citizens. That's what you were trying to say. Here for everybody is the same. 250 to 5 lakhs, no problem, same 5%.
Yes, to my country is all corruption, and so we will prove to Pakistan is not less than any other.
I love Pakistan. I will sacrifice my life for Pakistan.
So as against 5 to 10 lakhs of 20%, you have 5 lakhs to 7 lakhs 50,000 10%. So here you save 25,000 a year. 7 lakhs 50,000 10 lakhs. Again, under the existing tax regime, it's going to be 20%. So here it's going to be 15%. So therefore, you save another 5% here. So that means between 5 lakhs to 10 lakhs under the existing scheme of things, you will have a tax of 1 lakh. So whereas here you're going to have 5 lakhs to 7 lakhs 25,000 and another 37,500 between 7 lakhs 50,000 to 10 lakhs. So therefore you are going to have a tax of 25,000 plus 37,500, 62,500 as against you're going to be having a tax of 20% of 5 lakhs. That effectively is going to save you a 37,500 rupees of tax. So if you are between up to, of course, in any case, up to 5 lakhs, there's not much for you to plan, because in any case, entire income is going to be debated under Section 87A. So there is going to be a 37,500 of tax. So of course, you're not going to get 2 lakhs of 24B. You're not going to get the standard deduction of 50,000. So you're not going to get ADC of 1,50,000. So you're not going to get any of the deductions. And therefore, the idea seems to be here, they don't want in one stroke, because we have been always contemplating. Let's have a very simple system of tax with minimum deductions and a more easier tax regime. But I don't think it's going to be, as we have already seen, generally we are a little bit very sensitive. So when suddenly the benefits of Chapter 6A, 24B, standard deduction, non-professional tax, all of them are removed, it just generally has an upsetting feeling, especially on individuals that you've always been, they're always paying more tax than others. So therefore, the government is trying to do a little bit of a balance here. They come back and say, look, you want to continue, claim the benefits, go on a scheme, or we will not give you any benefits, but instead we'll have a slightly different tax. Though I would have definitely found the finance minister, despite the fact that there could be some potential tax revenue, I would not have get this. It just looks like an arithmetical progression with 5%, 5, 10, 15, 20, 25, 30. I would have been a little bit very honest with you, notwithstanding the potential revenue loss. But I think I'm doing something big here. So therefore, I would not have kept this kind of multiple slabs. How many slabs you have? You have to make it a little bit more simpler. I would have definitely tried to convince the both the Prime Minister and, in case if he has got any mistake, well, you would always welcome it. So I would have considered a big plan. So from 2,50,000, I would have definitely moved to 15 lakhs, and then I just would have made a little bit more simpler so that people choose this scheme. But right now, very honestly, this is the beginning. I hope that in this budget, we have a bigger gap. It can't be 250 to 5, 5 to 750, 7 to 10, 10 to 1250, 1250. Thank God it was not 15 to 17.5 and all. So when you make a big thing, possibly we could have done a little bit more. There could be some revenue constraints. I do agree with them. But however, it's just the beginning. The idea behind why I have to give an option is because I don't want suddenly, because you might have taken some ATC already, you would have taken some LIC premium, you would have taken some housing loan. So already you have taken. Suddenly if you would have come back and say, look, I'm not going to give any of them, and you have to compulsory choose under this scheme, possibly would have resulted in many objections. So therefore, it's the beginning. Hopefully in the next budget, that 5 to 750 is removed, and you got to have 10% only 5 to 10 lakhs. Then of course the next gap is 10 to 20 lakhs with only 15%. It should make it a little bit more attractive. The idea behind the scheme is to have reduce your claim for your ADC and ADD, because that requires some processing, some requires all those things. You make it simple. It's just the beginning, but with a wider gap, I'm sure that more and more people will be in a position to do it. But virtually, if you want to go to the new scheme, you have to forego many things. So LTC, HRA, special allowances, even I don't understand this 1032, they can remove for everybody. It's 1,500 rupees per child. And if you're not going to increase that amount, why we are wasting our time in keeping this section and say that a new scheme will not get it? I think these are some things which they have to really very think fast. The 57(2)(a), the family pension, the section is only 15,000 rupees. Why the hell you keep the section? Either you make it as 15,000 in line with section 16 or don't take it. So interest on self-owned property. There's so many other things are not available. And when you have to forego this and then including Chapter 6A, I don't think it's become a little bit more attractive for you to go to the new scheme, given the slab rate difference. As already seen, at 10 lakhs just gives you only a 37,500 rupees of benefit. It's not going to be very significant enough for somebody to motivate if you have already stayed invested in many of your Chapter 6A, 24B standard deduction types. I don't think switching new tax regime is going to be that simple. So it's going to be for my father-in-law, it was very simple because he never had any of this Chapter 6A deduction, nothing. So it just suited him for us to go for that. So unless you go to have a plain vanilla of no big benefits under 24B or Chapter 6A, I don't think that the new tax rates are attractive enough for you to move. So I think that's what they should try to in this budget. I think, as I told you, our chamber also should come back and say why a lot of people have not joined. They're going to take the statistics of how many people move I'm sure the government should reduce that data on first February inspect. I think that data they should give. I don't think a significant set of people would have moved to the new tax regime, which was intended for more simplification. So you don't get a set off of depreciation, don't get set off of income from house property, don't get additional depreciation. So a lot of things are still not make it attack. That is the last one, not allowed to claim any exception deduction for allowance of works provided and any other law for the time being course. They are trying to meet a professional tax and other things which you get from some other section. So it's a very sweeping things which they are just trying to provide. The one interesting point is that the distinction they're trying to draw between a businessman and others. Logically, the reason seems to be already companies which are having business, once they exercise, they're not allowed to get out. They want to bring the same thing to an individual HF having a business. Once they exercise the option, they have to continue. But only difference is they are allowed to withdraw from the scheme once after the initial option. But after that, they can never get back unless they close their business and they don't have any business income at all. But if you're not going to have a business income, you can choose this option on an year-on-year basis. You have an option of choosing year-on-year basis. A lot of people ask me the question, why there is a distinction between businessman? I think the only reason seems to be the other sections of 115 BA or BAB, which is available for companies. Companies are normally expected to do only business. For them, they don't give them the option of withdrawal. I think they want to continue the same thing for individual and HUF also here. As we discussed, they could have made it a little bit simpler. They can say for everybody you want to choose year-on-year basis, but that is not the way laws are framed. So they say that if you are a businessman, exercise, continue, and you are allowed to withdraw only once. But if you are not deriving income from business, you have an advantage. So you can withdraw this on a year-on-year basis. So that is one option which you get. As far as 192 is concerned, you have to really intimate the employee each previous year. In case if you don't make an intimation, he will do under the normal tax rates, and you have an option to choose at the time of filing your tax return, and accordingly either claim refund or so you pay the differential tax. So that is something which more clarification on this particular point. So again, of course, these are all procedural as to what is the methodology you should adopt for the purpose of paying the tax. So very interestingly, what is very important is a rebate under 87A is available under the new scheme also. AMT is not applicable, and of course surcharge and cess are applicable. But unlike the other 115 BA B, where we had a confusion on what will happen in the case of 111A or 112 or 112A, I think here no problems at all. I think for the income other than what is mentioned here, you can special rates will continue to provide, and you can still take 15, 20 or 10% tax or 30% tax into 115. So BB. So I think the chairman Anand will be saying a sigh of relief, because normally in a 2 hours program, so I generally don't complete even 50% of the slides. So in fact, with great difficulty, you'll explain, Suresh, close today's program. We'll have one more session for you. So that's a way he tries to convince me to stop it. But today, I think I'm making the job easier. Dot 5:59. So exactly the 1.5 hours time given. So I think I've ensured that I'm not going to give that difficulty to him. So thank you once again for your patient listening, notwithstanding the challenge we had from unknown person. But if you have any questions, I'm happy to take over to President and Chairman for
questions. Any questions?
People who like to raise questions can raise their hand and they can directly ask.
Please unmute yourself and you can ask. I think we can take it. There's no question.
I think the explanation given by Suresh has been so good. I think there are no questions. People have to assimilate and then come back as to what he said.
Yeah.
Thank you, Suresh, for the wonderful presentation. Definitely, you have lived up to your expectations, and we are very glad that you accepted our invitation and made a good presentation. Now over to Acha for the formal vote of thanks.
Am I audible, sir?
Yeah, yes, sir. Yes, sir.
Yeah. Good evening. Respected Sri C.A. K. Suresh, President, Hindustan Chamber of Commerce, learned Speaker Sri T.G. Suresh, Sri C.A. P. Anand, Chairman, Expert Committee for Direct Taxes, and dear members. First of all, I would like to thank office bearers and Chairman, Direct Tax Committee for giving me this opportunity of proposing vote of thanks. I profusely thank learned Speaker Sri T.G. Suresh, who is a hero and role model for many chartered accountants. As usual, your subject coverage was extensive. Your grasp on the subject is excellent. On my own behalf and on behalf of Chamber, I wholeheartedly thank you, sir, for sparing your valuable time and addressing our members. I also thank you for providing certain inputs for pre-budget memorandum to be drafted by the Chamber.
Exactly.
I also thank Sri K. Suresh, President, for his role. I would like to thank Sri C.A. P. Anand for arranging the meeting so meticulously. I thank each and every member for attending, and without whom the program would not be successful. Last but not the least, I thank Madam Chitra and other office staff of Chamber for their support. Thank to one and all. Thank you, sir.
Thank you. Thank you,
Thank
sir.
you, sir. Thank you. Thank you all. Please continue your support. Thank you.
Answer disconnect mic, ma.
Panilla.